Martin Wolf, picking up on Adam Tooze this morning in the print newspaper, yesterday online, was talking about this. We're in a poly crisis. We're in a crisis that mixes national security, geopolitics, economics, and hunger and social and health, of course. And Martin sort of went through, well, what do we do about it? I think his conclusion was, well, we all need to worry about everything and try to connect things together. I'm going to bring it down to a bit of a lower level, but just against a backdrop. And John and I were both at a dinner discussion this week with the former National Security Advisor, who was pointing out that we are now have a number of hotspots around the world where one could imagine war. And that is a very big difference from how it was in the post-Second World War period. And obviously we have an actual war in Europe. We have rising hostilities between the two major economic powers, the US and China. We have nuclear sort of at least performative and maybe worse in North Korea, in Iran. And the world seems to be fragmenting and less good at organizing itself to avoid actual war. Bringing it down to that's a truly, obviously, black swan event. If there should be more war, I'm happy to talk about what others have been saying and what you all think about either what will happen in Ukraine or how dangerous it is with China. But I wanted to bring it down to three key areas of this poly crisis that really matter for us and for investors and our clients. The first is inflation, and linked to that, interest rates. We know that inflation is at 40-year highs. There's a little bit of good news from Europe today or yesterday that they saw the annual inflation rate come down a bit. But this is going to affect everything. I think the markets, we've been saying this in the newsletters, and by the way, I'd love any comments that people have on those, that the markets have been constantly sort of, it's like trying to restrain a horse that wants to run, constantly thinking that the Fed is going to ease before we think it's likely that they're going to ease. And Jay Powell is speaking right now, but I understand that he is saying, yeah, maybe we'll only do 50 basis point increase in December. But after all, that's a 50 basis point increase, which is a pretty huge one, except that we've had all these 75 basis point increases. So it's going to take something to cure inflation or to bring inflation right down. There is a debate, and Olivier Blanchard is writing about it today. Maybe we don't need to get back to 2%. I'm more in the Bill Dudley camp that if you start fiddling around with the target now, even if in the back of your mind, you might be comfortable with inflation, if you're the Fed, if inflation comes down to 3%, to put that out there would be damaging to credibility. And so the whole nexus of inflation, interest rates, what is that going to do for equities on the one hand, but also bonds? Do we get back to a world where investing in bonds makes more sense than it used to? That is a huge issue. The second thing, obviously linked, is the slowdown. And this must be for the US, the recession that has been predicted and predicted and predicted and not yet here. And we've seen the second Q3 report today. It hasn't happened this year in the United States. And probably it will happen, but that depends also on the first point about what's happening with inflation and interest rates and how high rates have to go. There's definitely going to be slower growth, I think, and going forward than there has been. 2023 is not going to look as good as certainly last year and maybe even this year. And it may be that in Europe there already is a recession, although the data there have not actually shown that either. And a lot will depend, well, part of the gloom, I think, which is reasonable, is we have this terrible position in the second largest economy in the world, in China, where growth really has underperformed and is likely to continue to underperform. And that will affect the rest of us, probably more of an impact in the region than elsewhere, and also in Europe, particularly Germany, where China's inability or slowdown is slow, which is caused mainly by the zero COVID policy, but also by the property collapse and Xi's general shifting, is going to dampen the exports and the export machine of Europe. And then the third thing is, well, if we look a bit longer term, I think there are very different views about after the recession or slowdown or whatever, after a return of inflation to more reasonable levels and to something where people can ignore the rate of inflation, do we go back to a world of secular stagnation and low real interest rates? Or are we going to have pressures on financing, particularly from climate, and how are we going to be managing the climate challenge? And then my last rather sort of doer thing is how do we manage that climate challenge and productivity challenge in a world where we're if not deglobalizing, we're certainly changing the situation of globalization. And I expect the sort of refusal or divergence between the US and China for based political reasons to continue. And I think that's probably bad for global growth and living standards. So those: inflation, interest rates, global slowdown, longer term, is climate going to provide lots of opportunities for great investment, or is that going to make life harder in the transition, especially given the US-China? So those are the things I put on the table, but love to hear from others. I can see John. I don't know if you want to kick off, John, and your views. Put me right.
Thank you, Carol. Thank you, Caroline, for putting me on the spot. But you've certainly laid out the key issues in an excellent form. I was sort of hoping you'd give the answers, and that make it easier on the rest of us. Let me start just probably a little bit with inflation, I guess. As I like to start, the starting point we have to remember is a demonstration over the past decade that central banks have a lot less control over price developments in their economies than people had ascribed, or that they had liked to suggest that they had. We've seen most of the key central banks for a decade fail to meet their price targets. And it certainly didn't do a lot for their credibility. And secondly, of course, culminating in the fantastic forecast miss by most central banks, and especially by the Fed, in a context in which they had altered their framework to provide a virtual, and I'm talking about the average inflation targeting framework, that provided, as I used to say, the Fed likes to be predictable, and they had promised us that they were going to be late to the party, and they kept their promise. Part of the problem, of course, was that in the process, I wonder if anybody had particularly noticed that so-called new framework, once the battle had been started, and inflation had shot up, the new framework offered absolutely no guidance as to what the Fed should do and how it should do it, and has led to a lot of confusion on the part of how should the Fed act, and how should investors view their actions. I don't want to prattle on at all, because I'm sure these are things that everybody else all of you have been thinking about and have opinions about. But I think it comes down to asking a couple key questions about if we want to start with the U.S., we can talk about Europe separately, we can talk about elsewhere. But given the intense focus at worldwide on the U.S. performance and on the Fed, key questions are, for sure, the rise in inflation was a surprise. Appears to have been a surprise to most market participants, as markets have reacted quite sharply. But I suspect that if there's a surprise in the reaction, to most folks, it has been the modest reaction in long-term interest rates, in which it appears consistent with the notion that the investors seem to believe that that medium to long-term inflation in the U.S. is going to return to being relatively well behaved. And so a question to be asked is that an illusion, or have they actually got it right? And to figure that out, we sort of, dare I say it, come back to the argument that's probably seems stale to folks: transitory versus demand-driven price increases. It's the arguments have puzzled me a little bit, because the evidence suggests that the vast bulk of the price increases in the U.S. were associated with food, energy, and motor vehicles. And obviously, it's going to take some time for things like the price of energy to work its way through the general price structure. But already, it appears that almost across the board, if we're looking forward and not looking backward in the price data, that there's suggestions that inflation is moderating. So the only reason I'm going to stop here is because I suspect we all have been thinking about this, and all have our answers as to what we think is going to happen. My guess is the Fed, despite its rhetoric, has been trying to regain some degree of credibility, and have tried to suggest that they've talked as if they want to be restrictive, but they've acted as if they're looking for neutral, and a pause when they get to neutrality, and a great deal of uncertainty about how they ought to be running their policies. But my guess is, as it usually is, that the Fed is, unless the Fed is really intent on becoming restrictive, and I think the only time we've seen that is the Volcker Fed, that what is going to matter most is our understanding of the underlying economy. And in that regard, I think there is reason for some optimism along many lines, and one of which then will lead into the equities. But I'm going to shut up, and that is that U.S. profitability has continued to hold up better than almost anyone had expected, suggesting that the underlying trends in the U.S. economy perhaps are more favorable than have been usually portrayed.
Great. I'd love to hear, I don't know, Deanne, Jessica, Leopold, who would like to jump in? Deanne.
Thanks, Caroline, and thanks, John, for setting us off on some of the big questions. I think it might be a little misleading to think about the current situation as a polycrisis, although certainly Martin has made that case. And I think the reason I'm uncertain about that is that crises come and go. And rather than a crisis that is coming and going, and especially the going, I think we're probably in a regime change, that we actually have shifted from a 15-year period, roughly, since the global financial crisis, where we had low inflation, partly driven by abundant Chinese labor. We had low interest rates because we had very low growth. We had plenty of liquidity because QE was flooding out from most of our big central banks. And we had a generally quite benign economic geopolitical environment backing up our economies. Of course, there were spats here and there, but what has changed is that now we certainly have a geopolitical environment that is anything but benign. As you pointed out, we have war right on the edge of Europe. We have the weaponizing of energy, and I don't think that that's likely to end. In fact, I think it could get worse. The situation is probably going to get worse, not just for energy, but I think Putin is likely to come up with some other frustrated attempts to weaken the European economy and the NATO resolve. We could easily see that we have strikes of our undersea pipelines, of our communication cables, etc. So I think we, at least if we're looking at the next couple of years, which is probably as far as most investors can manage, especially now, I think we are not going to see a return to the kind of neutral or even amicable relations that we had with Russia and China. So the new regime then, the regime changes into a period of high inflation, of rising interest rates, rapidly rising in the recent past, and signs of liquidity squeezes as QT begins to feed through the system, and indeed shocks themselves can cause problems for highly leveraged institutions, as we learned here in the UK. And with that, with those backdrops, I think that it's likely that we will see very sticky inflation. I don't expect that central bank actions, although they're necessary, I don't think they're going to be sufficient actually to drive inflation out of the system or down to the level that, as you say, we would like, where it's just not an issue any longer. I think that's because the indirect effects are already pretty strong in the service sectors. The labor market is very tight. And as John said, that's in some ways a positive feature of our current situation. That's why I don't think we'll have a deep recession. I think there'll be shallow, but probably long recessions, certainly in Europe. And the expectation then has to be that interest rates will end up at least in the 5 to 6% range if we're indeed still facing a 4 to 5% inflation rate by the end of next year. Now that's a guess, obviously, but I think the main point seems to me is that this is not a transitory thing. Inflation is now well embedded. Some of the supply shocks, the supply constraints on intermediate goods are going to remain because of the geopolitical situation. And in financial markets, I think we can also fear, if not expect, yet more shocks because of the highly leveraged institutions needing to rapidly shift their financing with higher interest rates. And of course, the less regulated shadow bank lending that's happening. So I guess my longer term view, if you can call it that, is that real interest rates are likely to remain well above zero for the next couple of years in a continued attempt by central banks to get back in charge again.
Wash down inflation.
Yeah.
Who else would like, Liaquat? And then I'm not going to get Kofi and Jessica. Liaquat.
So just to continue John's vein of optimism, I think the one thing that hasn't reappeared, except in sort of quite a modest form, is financial instability. We had the incident in the UK with pension funds getting offside, but in general, financial institutions have weathered what was a dramatic increase in interest rates really quite well, and credit spreads have remained well behaved. Which reinforces the idea that when the recession comes, it's likely to be quite modest. That recessions that are deep are not usually driven by just the simple Fed trade-off, the trade-off that the Fed has between curbing inflation and raising interest rates. So I'm actually optimistic about the economic growth in the next 2 years, or even though I do think we will have a recession. And I'm actually even more optimistic that inflation will come down. Underlying inflation is running at, let's say, 5%. It will come down. I think it'll be a stretch to get it down to 2. But, you know, frankly, a 3% inflation would not be the end.
Wouldn't be the end of the world.
Yeah, the end of my world.
Jessica, let's hear,
Okay,
let's hear from you.
alright.
You want it
That's
down to,
right.
you want price stability.
That's right. But well, some quick points, mostly stimulated by the excellent presentations and of course the great comments by my colleagues. The first is Paul Volcker was my first undersecretary. So I've been worried about inflation through decades of no problem. But as I often say, even a stopped clock is correct twice a day. So I think the time has come, and I would certainly back up Deanne and others' comments about inflation being an issue. The second thing is, quite apart from all the economic conditions and everything we can see, I just do not believe that the business cycle has disappeared. So whatever set of reasons human beings come up with to overshoot in one direction and then react in another, there will be recessions. We haven't had the end of the business cycle. The third, and I think it's probably the one that I feel is most important, is it's important to focus on monetary, but frankly, it's fiscal. Our problems are fiscal, and the Western world has a big fiscal problem. The deficits grow and grow. We keep assuming, and especially for the US, which is the dollar basis, that it can go on forever. But over that longer term, and I look to you others to walk us through how, I think the fiscal issue is more important than whether the interest rate is 2% or 2.5% in the end, with the impact that it will have. And I think there's a lot more to be said about the fiscal situation, and that is the long problem. And then, as you all know, the banking system is good thanks to other regulatory changes that had come before and the quality of their assets and all the rest. But when we look at the financial instability now, we're all looking at shadow banking and how that will transmit into the, if not the banking system, then at least the real economy in some other way. So I think I'll stop there.
Thanks. It's interesting on the shadow banking, because of course, traditionally that is where, or the unregulated sector is where problems come and feed back in, or less well regulated. And that was clearly the case with the pensions in the UK, I think. But in the US, it does seem as if crypto the crypto sandbox is mostly contained.
Yes, that's contained.
Which is, and there are some smaller banks that are involved, but maybe I don't know how they're funded. Maybe that will cause some problem, but not into the major parts of the financial system. Of course, another big problem that you talk about fiscal policy in the West, and the US is having contractionary fiscal policy now, although it's also getting, as Laura was saying, there's public money spewing out or planning to be spewed out on within the US with industrial policy. But there is certainly a debt problem in the poorer and emerging world, which maybe will feed back into our system, or maybe it won't. I don't sense that there's too much concern about that, other than on the part of specifically emerging market investors. I think we lost Laura, but Kofi, I'd love to hear your take on this discussion on what issues we should all be worrying about, and obviously any advice for all of us. And oh, there you are, Laura. Right, and for me on what we should be thinking about and writing about as we go forward. But Kofi first, and then Laura.
Okay. Thank you, Caroline. It's been a fascinating discussion. I guess what's been worrying me the most is the way the system overall is working. During low interest rate periods, it didn't really translate through the banking system in a lot of developing markets in ways that one would have hoped it would. It was still very hard to get relatively cheap money to do, to buy a house or to get working capital for a business, even when rates were close to zero in the US. It was still very, very difficult in a lot of those places. And now that we have, I think because a lot of the markets we look at, especially the ones that are democracies, if you get into power, you've got to try to do something. And they don't have much capital, so they borrow and take a bet. And I think more and more of them are losing those bets. So I think there's going to be more instability in a lot of those places because democracy is not really delivering. I think in the most developed markets, at the end of the day, I think the reason the markets aren't lower than they are today, one perspective might just be that, if things get really bad, the central banks will step in and save people just like they have in the past. But if you're in a developing market, that's not what's going to happen. It's just going to be real chaos. So I'm really worried about the way the system seems to work, where inequality just seems to widen. When interest rates were low, if you had a lot of capital and a lot of wealth, you did really, really well, and you did moderately better than you had been if you were in a developing market. That all gets wiped away very quickly with a few interest rate hikes and your currency going to a tailspin. I'm just not sure how a global economy is going to work well when it just seems like the structure is one where it's really, really hard for developing countries to get out of the box they're in. So that's what's really been on my mind a lot, because I do think there's a belief that I share that, if things get really bad, in the US, they'll find a way, right? The central banks to kind of keep everything afloat. The rest, other parts of the world, I don't see how they do it. And I don't see how they keep their societies stable.
Well, I want to go now to Laura, but and then back to Afsane, I think, maybe to sum up, because it would be nice to think, we always want to think about where are there opportunities, where are there some glimmers of hope. It's a little difficult perhaps in today's world, but Laura, maybe, I don't know, on the climate, all that you've done so much on sustainability, and it does seem as if the minds have moved there, but not the actions yet, although maybe the IRA will help.
Well, look, I have a mixed set of things, and I'm going to be really brief because we're really running out of time. Some of these are points of optimism, some of them are not. I certainly agree with the notion that I think the resilience of the system is showing up in terms of financial market stability. And I like your point, Caroline, about how we managed to sort of handle the shadow banking crisis. I think this is really important. It sort of suggests that the adjustment we're going through of higher interest rates trying to combat inflation is not creating financial market instability. I don't think it's creating it in Europe, and I don't think it's creating it in the US. It apparently did in the UK. Second thing, I really want to emphasize the importance of inflation expectations here. We talk about the loss of trust in the central bank. Maybe it hasn't been lost. Maybe everybody was surprised by what happened, but they're looking forward to the future and saying, they're going to get this under control. They're going to get us under control. They're going to get us back to a range of inflation over the next 3 to 5 years that we can live with. I agree that it would be a mistake to move away from the 2% target. On the other hand, the speed with which we get to that target, if we ever get to that target, we had that 2% target forever, and we didn't get to it on the underside. We may never get to it on the upside, but keeping it does seem to me important. Yes, I think we're going to have slower growth coming out of the recession because we are going to have slower growth. The demographics tell us that. The potential growth rate of GDP in the United States is significantly lower. That's it. Probably true in Europe as well. Here's a positive one. There's a really nice new study from McKinsey on global connections. You would be shocked to find out that despite all of the decoupling discussion and all of the deglobalization discussion, interconnections in the world are very healthy, and the supply chain disruptions have largely been corrected now. So the world trading system and the world financial flow system is still pretty remarkably strong and interconnected. Now, one of the concerns I have, of course, is China growth. And I think that is a key issue here because the growth of the global economy and of the many of the emerging markets that we worry about is driven by Chinese growth. And I am very concerned about that. Not much I can think of to do about it, except worry about it. Climate change, I personally think, it's the case that this is happening much more quickly than expected. The costs are mounting. We're never going to get to that net zero target. And that will just become more and more apparent over the next year, the next 2 years. It's a huge, medium-term and long-term problem. And then finally, I am a little worried about a possible debt default in the United States. I don't think that that's been mentioned here, but let's face it, this is what the Republican Congress is going to try to do. And how much can they extract from the Biden administration before they just go ahead with it? And I think this is a real challenge, and I would urge everyone on this call to mobilize all of the financial institutions they are associated with to put enormous pressure on the Republicans in the Congress to make sure they understand this is not possible. The devastation that this would cause to the global financial markets is something that they need to understand. So I'm going to end with that. That's something we can do. We can try to get that message to the Republican Congress. So.
That's true. Okay, well, look, thanks very much, Laura. Thanks to everybody. Well, take that in. And again, very open to any suggestions that any of you have or critiques or whatever. Let me turn it back to Afsane to close it out. You're on mute.
I'm sorry, Caroline. I was going to say, we're going to come to you to close out, I hope, but just a few thoughts on what I just heard. And as usual, you were very generous, and I learned a lot. And I think thanks to, by the way, the weekly letter that, as you know, Caroline pens, we force ourselves to turn this kind of conversation into, so what should we do on our actual investments, you know? And I'll go sort of one step back first and then come to that point. But personally, I'm between Deanne and John in terms of optimism and pessimism on all the things that we talked about. So maybe sort of somewhere close to everyone, but I'm a little bit closer to John in some ways, but a little bit closer to Deanne on other ways. But I'm with John in the sense that I think even though wages are not going up enough in real terms, they have moved, and the shortages in labor markets have not just, are moving up the lower end of wages. And the lack of immigration has also improved lower wages in the US, speaking for the US, right? And so when we come, as we go into a slowdown, potential recession, but a slowdown of some sort, that group will have a much bigger, will continue to have buying power that they actually exercise versus the higher end that does not really consume in the same ways. So I think that helps somewhat dampen that sort of general, very strong recession possibilities in the US. So more positive on that. And where I am closer to Deanne and what Kofi also said is, and I've sort of said this throughout the whole meeting, just looking at the flows and looking at, these big pools of money. These big pools of money were going into emerging markets in private areas, in foreign direct investment. There was foreign aid of different sorts, multilateral aid, and then there was also equity markets and bond markets developing, right? So the flows are not very up, as again, looking through the numbers, not just the ones we're seeing, but we see clients who had like a 12% allocation in their total portfolio to emerging markets, reduce it to half of that in emerging markets. It's not just the market correction, it's also the share. When you look at Stanford and Yale and others who had very large allocations to emerging markets, a lot of that was China. And people are very nervous about allocating new money to China. There is the Sequoia bill in front of the Congress, right, which is do not invest in innovation in China. So that is going to be kind of both on the private end and public end of the market. There hasn't yet been sort of a general political move to move out of China, but that's, we wouldn't be shocked if there was suddenly, state laws that said we don't want to invest state pension plans or something like that in Chinese stocks. So I think there could, emerging markets, where are the flows going to come from? As Kofi said, I just don't see that. Plus the positive part in emerging markets, which is things like we're seeing unbelievable growth in fintech. We talked about that, but like Brazil, India, LATAM in general, Africa, huge in terms of payment systems. But this is all innovation, venture, smaller companies. Climate, we saw with COP27, very little money going into emerging markets, right? The majority coming into the US. But not because of just the IRA, but because there's not a lot of dynamic spirits happening. Now, Deanne would know a lot better whether we will see flows into Europe with what is going on in Europe, because that also could see big flows on the climate front for obvious reasons, because you have to diversify from Russian natural gas. So flows will go there too. So this big moves into climate will be US-Europe focused. China may do its own bit, not for global reasons, but for local reasons. Other countries are going to have difficulty. So everything we're seeing on the multilateral front and on, the work that a lot of people in this group have also done in terms of getting capital into emerging markets, we need to really put our thinking hats on and see where that is going to come from. Because I think there's a big question mark. And where we see, like I said, huge still interest in the market is really innovation in health, biotech, which was dead. So that I think is a very big area when we look across, Caroline. Innovation in water, and you heard from Justin about the Ceres that reduces water use. I mean, that's one way of looking at things. But water sources, but also water purification, water quality, water services related to water, all over the world. We think huge opportunities, food and ag, because again, that's the theme. As we are in a world where there is more appetite for high quality proteins, but also all the things that we all know about. There's just a lot of interest suddenly on the part of very sophisticated investors going into food and ag, and the investments that we have made has been alongside the biggest investors like CPPIB or Temasek or GIC. So we're seeing that is sort of where flows are going. And then of course we talked about renewable energy, which is I think going to help us with not just getting sources of energy to cleaner energy, but an engine of growth, going back to John's point, in terms of being positive about growth. Again, positive about US and G7, and I think Caroline concerns about how do you get the flows into emerging markets. And we expect Chinese assets to go down, in terms of foreign interest. Doesn't mean that local interest or money from the Middle East, etc., is not going to go in there. But in terms of the big flows from US, Europe, and the biggest sovereign funds out of many countries will be more careful.
Yeah, well, I think that's a pretty great summary. It's probably not comfortable for any of us to be thinking, yeah, well, in the end, the US is the strongest and the place where we should put money, at least in innovation. That's a little bit more exciting. And we have to keep looking for the other places where there can be exciting innovation around the world to help with all of the problems. But so thank you all very much. I think, we've managed to, we very much hope that the next board meeting, we will actually all be around the same table and, saying goodbye to COVID, if not a proper goodbye, at least where it's a diminished feature of life, as they have to come to in China somehow or another.